Jai Janendra, everybody, and welcome to our financial education program. On behalf of myself, Vinay Shah, and Paresh Shah, my co-host, welcome to you all on what is one of our series of webinars that we've been doing to educate the Oshwal community on financial matters. We've been running a series of seminars for the last few months, and this is the fourth in a series of 8 seminars, which is based on mortgages and all the details that we want to talk to you about around mortgages and what a mortgage is and the criteria for mortgages and types of mortgages and things like that. So as I mentioned, we've designed these sessions to educate members of Oshwal community and all our people who have watched these YouTube videos in the past, and we welcome everyone. We're going to provide an overview of many of the financial topics that relate to personal finance and planning. And as always, as we've said before, this is not advice. We're not giving out advice. We're just giving people an education on what mortgages are. And if you do require further details and you require more qualified knowledge, then it's best to seek advice from a professional who is qualified to give that advice. Next slide, please. Next slide, please. So just before I start the presentation for today, I just wanted to again thank everyone for the feedback that we've been receiving. We've had a lot of positive comments that people have made to us for these sessions, and a lot of people have said that we have made things much easier for them to understand. We've broken it down in a way that is easily followable by people who don't necessarily understand these topics. And a lot of people have found out new things. For example, last session we talked about ISAs, and many people commented that they didn't realize there was an additional ISA allowance for children known as junior ISAs. So thank you for all the feedback that we've had, and we hope that you will continue giving us feedback so that we can constantly improve if necessary, and welcome all your positive feedback. Thank you. So next slide, please. So as I mentioned, today's session is on what is a mortgage. In simple terms, a mortgage is a loan that is secured on a property that you intend to rent or to live in its simplest format. I'd like to pass over to Paresh, who's going to carry on with the next slide.
Good evening, everyone. Jai Janendra. Hope you're all well. And as Vinay said, thank you for all the wonderful feedback and constructive feedback we've had from our members watching across UK and abroad as well. So just today's topic is about mortgages. I think everybody's got a mortgage or has had a mortgage at some point in their lives. Today is really to elaborate on some of the process and some of the things people aren't aware. And as advisors, we get asked lots of questions, and you think sometimes people know all of these things, but they don't. So it's really, those that know, obviously, seasoned buyers and of investors of properties will know, but people don't always know the process and what happens. So in simplicity, you found a property, you negotiated the price, and you've then gone to the estate agent to accept the offer. So once the offer is accepted, buyer and seller have agreed a price, you get a memorandum of purchase, which is effectively heads of terms to say, look, this is the buying price, this is the selling price, who the vendors are, who the buyers are, who the solicitors are, and the buyer solicitor. So once you've done that, or at the same time, you're trying to source a mortgage, find a mortgage, and apply for a mortgage. So once you get that mortgage process underway, you'll obviously at the same time again engage with a conveyancer, solicitor or conveyancer. Again, it will always be good to find a solicitor conveyancer that knows and deals with all the lenders on the market. It tends to be that a lot of times people will go for price or somebody that's local, or all of those things are not as relevant as they used to be. Firms can be in Liverpool, Scotland, not Scotland maybe, but other parts of the country. With technology, they can and tend to be much easier to deal with, and specialist conveyance is always better. Valuation and survey types. What would you do? Usually there are three types of surveys. If a lender is, if you're getting a mortgage, a lender will do their survey, which is just effectively a one-page survey. Yeah, is the property in good condition? Is it livable, habitable? And they will say, yeah, okay, fine. It's literally a 10-minute, 15-minute the survey, walk in and out. Generally gives you an idea of if it's a good property. And then second one is a home buyers survey, which gives you slightly more in-depth information about that, which you can engage directly with the surveyor locally who knows the area and the properties. And third one is a full structural survey, which is a longer survey. In terms of cost, the lender's valuation, sometimes there's no fees involved, but there may be a fee depending on the lender. Home buyers, depending on the type of property, on average, you're looking at, if you're looking at a £500,000-600,000 property, you're looking at around £400 to £500. And then the structural survey, it can be anything upwards of 1,000 plus VAT and so forth. So once you've got all of those, the lenders have checked you out, you've had your survey, you've got your mortgage application going through, you'll receive a mortgage offer. That mortgage offer tells you what you're going to be borrowing, how much the interest rates are, what the terms are, what the exit penalties are, i.e. redemption penalties, and what the terms are effectively. Most of the time, the lenders don't require you to sign the offer, but it's a document that you should read carefully and go through to make sure that you're happy with all the terms and conditions. Once that's done, solicitor or conveyancer will go through the process of conveyancing, making sure that do the searches on the property, make sure there's nothing untoward about the property and the location. Local authority searches will be done. Once they've done all of that, you're then ready to exchange, which means you're obligated to buy and the seller is obligated to sell. Once that's done, usually you need to put down 5 or 10% deposit, and then a few days after or within a month, you would complete. That completion, obviously, you'd pay the remaining of deposit, and the lender will then pay the money across to the conveyancer, and then you hopefully at the end of the process you get your keys. So over to Vinay now.
Thanks, Paresh. Next slide, please. So I wanted to go through the eligibility for a mortgage. So all mortgage lenders have particular criteria which they follow when they are providing mortgages to people looking to buy homes. Some of the criteria revolves around the eligibility of minimum age and maximum age. So for example, residential and buy-to-let mortgages can be taken out by 18-year-olds as the minimum, but usually most of the lenders now restrict to age 21 as a minimum age, and a maximum age, depending on whether it's a residential mortgage or a buy-to-let mortgage, can go anything from 70 to 75 for residential mortgages if you can prove that you will have income in the later years in your life. And a buy-to-let mortgage can even go up to 80 or 90, again, dependent on your circumstances and obviously the viability of the rental that will keep coming in from that point. When you're looking at income, obviously mortgages are only approved on the basis of the income that you have, and so therefore you do have to have an income that you can prove. And depending on whether you're a self-employed person or whether you're an employed person, the income criteria is different. So for example, for an employed person, normally you'd require at least 3 months pay slips, 3 months bank statements as proof of your income. And if you're self-employed, you normally need at least 2 years accounts to prove the profitability or the income that you sustain or derive from your business. The other thing is also traditionally when mortgages have been done in the past, most lenders have normally granted a mortgage based on a multiple of your income, which is now really changed, whereby most of the lenders now will base their lending decision on affordability. So what that means is they take account of basic costs and basic commitments that you have on a monthly basis, and they take the net income that you have minus your costs to give you an amount that you can afford reasonably on a monthly basis, and that then dictates the amount of mortgage that they're usually able to grant. Unfortunately, every single lender has different criteria around this area, and therefore, by going to 10 different lenders with the same income details, you can get 10 different answers as well. So just be aware of that. Property types, there are different property types as well. So normally tile roofs, brick construction is normally acceptable, although in some areas there are some types of properties such as steel construction or concrete construction, which are not always acceptable to some lenders. So you just need to be careful what type of property you're buying and which mortgage lender you're going to in order to make sure the two match up. When it comes to residency, normally mortgages are granted to people who have UK passports or UK nationals, and it will also be granted to people who have visas or indefinite stays in this country, and also sometimes to expats, although that is again a very specialist area, and not all lenders lend to expats. So I mean people who work abroad, who are UK nationals but will return at some time in the future. One of the biggest things to be aware of is a lot of the eligibility for a mortgage is based on your credit report, and we'll come back to that later, but credit is very, very important. The report is, very, very important from the lender's point of view to work out whether or not you will be a good candidate to lend to if you've been able to sustain any commitments that you have taken on in the past. And also the other factor is the number of applicants is something that you do need to be mindful of. Normally it's a joint mortgage between two people, although some lenders will lend up to 4 people at a time. Over to you, Paresh.
Hi, thanks, Vinay. I think a couple of things there. You've forgotten maybe the shared ownership and help to buy. Yeah, so shared ownership, it works on the basis of you buy a share of the property and rent the other part, allowing you to buy the rest of the shares as you go along. And it's a popular way of buying because in London properties are quite expensive. So somebody getting on the first time on buy a ladder is an ideal way of starting property ownership on a small scale. So you can start from 25%, 40, and escalates over a period of time. So that's a good way of doing that, especially in London. There's plenty of properties that are being built, particularly for shared ownership rather than outright buy. Also, help to buy, which has been a popular where the government will pay up to 40% of the deposit. You have to contribute 5%, so effectively you're getting a 55% mortgage. the government back recently, government back 95% first-time buyer mortgages. This particularly is a good start for a lot of first-time buyers, but it does not mean whether it's shared ownership, help to buy, or government-backed. A lot of people are under misapprehension that it's available. You have to have the income to support the mortgage that you're borrowing, and you have to fit the criteria of the lenders. The government backed is simply that they will guarantee the lender if you should fail to pay the mortgage up to a certain amount, but the affordability rules apply at all times on all the mortgages that you apply for. So, thank you. Next slide, please. So repayment methods. Essentially, we've got interest only and capital and interest payments. Interest only is fairly rare on residential mortgages. You do tend to get residential mortgages on interest only, but you have to have strict income criteria. It could be that you have to have a certain amount of income, minimum income, before you can qualify for an interest only. Interest only mortgage is effectively that you are only paying interest on the amount you borrowed, nothing more. You're not paying away the capital. So if you owe the lender £100,000 today, in 25 years' time, you'll still owe them £100,000. You won't have paid off any money to that. It's popular with some people because they have, bonuses coming in or potential inheritance. They will be paying that off in chunks. Capital interest, the most popular type of mortgages, and lenders, 90% of the lenders will always do prepayment mortgages. There's a few lenders that will do interest only, but not enough. At least on this capital interest, you are paying off the mortgage on a monthly basis, and in a period of time, usually 25 years, the mortgage will be repaid and you owe the lender nothing. The term of the mortgages does change. Now the younger people, now you can go up to 35 years a term of mortgage, making it a bit more affordable for people. So over to you, Vinay.
Thanks, Paresh. So I just want to go through the different types of mortgages that are there for the interest rates. As you can see, there's a number of different types of interest rates that are there. Let me go through each one individually. A tracker mortgage is effectively where the mortgage will track the Bank of England base rate by a percentage above the current Bank of England base rate. So for example, if it's 1% above the Bank of England base rate, which currently is 0.1, then you'd pay 1.1% as an interest rate. However, the mortgage rate, the Bank of England base rate, can go up and can come down, and therefore the amount of interest that you pay, the rate, will also then mirror that by going up and down in line with the Bank of England base rate. Fixed rate mortgages, as its name suggests, the interest rate is fixed for a number of years, usually between 2 and 5 years, or even possibly longer, and just gives you that stability in knowing that if interest rates do go up and even come down, you know how much you're going to be paying on a monthly basis for that term of the mortgage being fixed. So it can be quite good for many people, and given the fact that at the moment interest rates are extremely low in comparison with the past, could be a good way to fix a rate at this current levels. Ultimately, interest rates will go up one day. We don't know by how much or when. So therefore, this would give you some stability for a number of years. Discounted mortgages is not something that we come across very often these days. Used to be quite popular in a few years back, where the mortgage lender would grant you a discount off their variable rate for a number of years. So what it is you effectively pay a lower rate of interest to start the mortgage off, and then after a number of years, the mortgage goes back to the standard variable rate. LIBOR stands for London Interbank Rate. There's not many lenders who work on this rate. and the ones that do are now moving away from this, as the FCA has suggested that it's not the best type of rate for mortgage lenders to peg their rates against. They have been replaced by other measures, and one or two lenders who do lend on this basis have now started to move their mortgages across to other types of rates, tracking different types of bank rates. Standard variable rate is a rate that is set by the lender, and they can increase or decrease that rate at any time. It doesn't have to be linked to the Bank of England base rate or LIBOR rate or any other rates, and they make the decisions based on their own thought around what the rates should be. And this particular standard variable rate tends to be the most expensive way to borrow, but because there are normally no tie-ins, it can be a good way to borrow if you're looking to pay off the mortgage quickly. So all the other types I've mentioned before, like tracker, fixed, discounted rates, if you try to pay off your mortgage early, there can be penalties for doing that. And a lot of lenders do then give you an amount of capital that you can pay without hitting or incurring any penalties, usually 10 or 20% of the capital. Offset is another type of mortgage where you effectively get a current account, and you basically can deposit money into that current account, and your mortgage is then, the interest rate you pay on your mortgage is offset against your mortgage that you're borrowing. So for example, if you have a £100,000 mortgage, but you have £20,000 in your current account with that lender, then effectively you pay on the interest rate on the 80%. So it can be a good way for people who have large deposits of money or are looking to build up that deposit but not necessarily pay the mortgage off early, and just want that flexibility to be able to maybe pay it off later on or something of that nature. And usually offsets are based on tracker rates as well. Over to you, Paresh.
Thanks, Vinay. So now going down to affordability, which again, conversation that I had with the client, the people are assuming that you will be lenders lend on income multiples. They do, but unfortunately, fortunately, the rules have changed. It's based on affordability, and lots of factors come into play here when you're looking at how affordability is calculated. Income multiple is a straightforward one. General rule would be that a lender would lend typically 4.5 times income, maybe a little bit more, maybe a little bit less. But in addition, they will look at your regular commitments. Regular commitments could be you've got a car loan, you've got a credit card, you've got a loan, personal loan, you've got childcare costs going out, school fees. All of those factors will be taken into account when they're looking at how much they could lend you. Age is another factor. The older you are, the shorter the term. Therefore, the affordability rules are going to be much more stringent. So for instance, if you're a 50-year-old, more maximum age that a lender will lend is to age 70 on residential mortgages. So just be aware of the age comes into play as well. That's why I said earlier, 70, a lot of younger people getting on the first time on the housing ladder, they could borrow up to 35 years on mortgage. So that's another point to remember as far as affordability is concerned. The term, as I said, it could be 5, 10, 15, 20 years. The shorter the term, remember, the higher your monthly payments are going to be. So the longer term gives you the affordability, and most of these lenders will allow you to repay up to 10% overpayment. So if you do have a longer term, but then you've got some money, you can overpay and reduce your mortgage balance that way. A really good way of reducing your mortgage quickly, but yet you're not committed to paying higher mortgage payments. You can pay as and when you can, and you maintain that monthly payment that you have throughout the term. And most likely you're not going to stay in that same property for a long time if it's your first property. But it's longer term makes sense from a cash flow point of view. But it's down to you, your decision. If a lender's prepared to lend you 25 years, fine. If it doesn't quite get you what you want, it may be a bit longer. Vinay?
Thanks, Paresh. So just moving on to taxation on residential properties. So when you sell a residential property, there is no liability to income tax. However, if you're selling a property, if it's not your main residence, there can capital gains tax is not also payable, inheritance tax could be payable depending on your personal allowances. So just be aware that there's no income tax on residential property, there's no capital gains tax, but there could be a liability to inheritance tax depending on the value of your property and your personal allowances. However, there is a little known fact that you are allowed to rent a room in your property, a residential property, for a rent of up to £7,250 a year, and that is tax-free as well. So there's no income tax on that. So a little caveat in there, which sometimes, could help someone who's renting a room or another way of maybe earning some income if you have a big house and don't have the need for some of the space that you have. Over to you, Paresh. Paresh?
Sorry. In terms of buy-to-let properties, it's become very popular in the last few years for people to own a property because it's a safe investment, good rental income, and you can see and feel the property, whereas other investment people aren't able to see. This is kind of tangible, so people feel owning a buy-to-let property does give them good return. Has given good returns to a lot of people. So what do you buy it? Do you buy it in personal name? Buy it in limited company? Personal names. You buy it, you own it, and you pay the mortgage on it at a buy-to-let rates. The rates are generally better on personal buy-to-let, and becoming more popular now. Is people buying in limited company. One of the benefits of limited company is it becomes easier for you to pass on the property to your children, or you can share it with other people. You've maybe a group of friends want to buy a property. You can pool resources and buy a property and build up a portfolio from there. Vinay will go into the taxation of buy-to-lets in a second. In terms of general preference, it's an individual preference: personal property, personal name, or limited company. Limited company, you will pay slightly higher rates, but it is becoming more and more popular.
Thanks, Paresh. So just to go through the criteria for buy-to-let properties, as you remember, from residential properties are based on affordability based on your income. Buy-to-let properties are normally based on a calculation on the rental income. So it's a different calculation from the one for residential. And these normally are based on the rental amount that you're going to get from the property with an additional amount of cover that's put into it at 25% above the rental amount, or 145% of the pay rate based on the variable rate. You can use something called top slicing, which basically means if you have a number of properties already which have excess rent in them, which are above and beyond the amount of rental cover that's needed for that property, then that can be used to offset some of the requirements for another property, which can benefit you if you're a landlord or have a number of properties in the background. Traditionally, most lenders will request that you have an additional minimum income of about 25,000, although there are some lenders who do vary that sometimes, But traditionally, they would ask for you to have at least some cushion, which is personal income, in case your property is not rented out or is void, or the rent is not coming in on time, just to make sure that you can cover those periods of rental voids. Buy-to-lets, first-time buyers can get buy-to-let mortgages. However, traditionally, those are not based on rental income because you have not got any sort of you aren't a landlord already or have some experience in the landlord market, and therefore the mortgage is normally based on a affordability again against your personal income. Over to you, Paresh.
Yeah. Next slide. So I think what a lot of people are aware that you buy a property to let and you let it to a family, which is the most common types. However, what's become popular recently, not so recently, is different types of lettings, houses of multiple occupants, which is generally people renting a room effectively. It could be that a single person lives in London. All they need is somewhere to stay for the week, so they will hire a room. It's cheaper than staying in a hotel. So that's one way. There are also people who are not able to afford larger rents, so they will just rent a room and become very popular. It offers a better yield on the whole. But obviously, because it carries slightly higher risk, you've got multiple tenants, potentially multiple problems. So it's one of those things that you potentially there. Also, buy-to-lets where lenders will happily lend on. You've got 4 flats within a house, they will lend on that. So there's four separate flats, but it'll be one mortgage across those 4 flats. So again, a popular way of increasing the yield on the property. Holiday lets, where you're buying property which is going to be let to holiday lets, or it could be service accommodation or Airbnb style. So it's one of those things that where people will occupy it for under a certain period of time, and it carries some quite good tax advantages, which we'll cover in a second. But holiday lets is another way of becoming popular, and people lending on there. So back to you.
Thanks. Next slide, please. So just to cover off taxation on buy-to-lets. So with buy-to-lets, because it's an investment that you're buying a property for rental, the rental income is taxable, and is taxable at added to your normal income, and then based on whether you're a low basic rate taxpayer or high rate taxpayer, then you pay income tax based on your marginal rate, which is either 20% or 40%. Normally, buy-to-lets are liable to capital gains tax when you sell the property. So basically, when you buy a property for, say, £100,000 and you sell it for £200,000, the £100,000 that you made as a gain is taxable, although there are some allowances for legal expenses and some other things which you can deduct against that. But the amount is then taxed again at a higher rate of capital gains tax than the normal one for investments, which is 18% for basic rate taxpayers and 28% for high rate taxpayers, whereas normal investments is 10% and 20%. So just to bear that in mind. Inheritance tax, again, is something that is normally applicable to buy-to-lets, again, depending on the value of the properties and your whole assets base, if it's beyond your personal allowances for inheritance tax purposes. And inheritance tax is charged at 40% and is payable when the second person, if there's 2 of you, passes away before that property passes down, say, to the next generation.
Thanks, Vinay. some of the taxes that Vinay mentioned are quite prohibitive for buy-to-let. A lot of the tax advantage that we used to have in the past have gone with buy-to-lets. However, if you look at holiday lets or serviced accommodation, you are able to take advantage of those tax benefits. Interest on any mortgage which is used for holiday let is treated as an expense in total, whereas on a buy-to-let it isn't. On a personal name, it's treated as an expense. Therefore, you can offset all your interest cost as an expense, and it is treated as business. So you can claim all allowances. Income obviously is taxable, less all your expenses, including interest, and the profits are taxed on the corporate on your personal rate, or if it's a limited company at the corporation tax. One of the best things about holiday lets, if you own it for a period of time, and there is a gain, as Vinay said, that on a personal buy-to-let or a company let, there's capital gains tax of between 18 to 28%. However, this qualifies for a business relief, which is up to £1 million. Any gain on a holiday let or service accommodation is taxed at 10%. So that's really a good advantage and good reason to think about something like a holiday let. Like all things, it's a business, and that business needs to be treated in that manner. And even a personal buy-to-let is a business, so it's worth looking at the finer details. And then, so the other considerations. Next slide, sorry. Yeah. So some of the things that I think people should be looking out for is make sure you're not on a standard variable rate. Check with the lender if you are on standard variable rate. You know, are there better rates available with the lender, and can you get a better rate? So always ask the lender or speak to your broker advisor and find out if there is a better rate available. And it's sometimes as simple as a phone call and a small short form completed, and you can go on to a better rate. An example where a client I was speaking to said, "I'm on a good rate." I said, "Okay, can I have a look?" Had a look. He was paying £800. A simple conversation and switch. Within an hour, he saved himself £300 a month. So it's a really, efficient. Just keeping an eye on your mortgages, reviewing what you're paying, and speaking to your lender, your advisor, broker, whoever it may be. But it could save you hundreds of pounds a month, and that could be used elsewhere. Again, remortgaging, rate switches. If the existing lender isn't offering you the best rate, look at other lenders. You can move to other lenders. Usually, some of the lenders will offer you, a fees-free mortgage, so it doesn't cost you anything to move across to another lender. However, you just got to look at the terms and conditions of all the lenders. Remortgaging for debt consolidation. A lot of people will, they've got credit cards or loans they've built up. They want to pay, consolidate, and usually they're paying 18% on interest rates. They want to try and reduce the cost of borrowing, so they would remortgage. And considering the rates at the moment, extremely low rates, we've never had rates this low on a mortgage. However, just do bear in mind that your credit card or a personal loan is an unsecured loan. If you do move it over to consolidate that into a mortgage, it becomes a secured debt. And that, as you know, that your house it may be at risk. You will read the warnings there. So personal debt is different from secured debt. Secured debt, you could lose your home. So just be aware of that when you're thinking of debt consolidation. Obviously, home improvements, you can borrow more to do that. Now, also, people are living longer now, so not everybody is able to pay off their mortgages because of, they've lost their job, they're not able to get a job, they've not been well, but they've got plenty of equity in the house. So retirement interest-only mortgages are becoming popular. Again, affordability rules apply, but becoming very popular in the late early development stage at the moment, and they will get better and better as we go along. One of the things we haven't covered here is equity release. Equity release. A lot of people have got houses worth a lot of money, no mortgage on them, but they've got no income. They've got very little in way of income. So they release equity from that property, and they pay interest-only mortgage or roll up the interest, whichever is suitable for them. But again, it's an important development, and it's still developing as people live longer. They want to enjoy life rather than sitting in a house which has no mortgage on it, but they've got no money to live a comfortable life. So I think we're kind of done on the slides. Next slide, sorry, Hannah. Yeah, so again, resources. So you can look at the Money Advice Service for more information about a whole host of financial planning subjects there. It's provided by the government, so it's a free service. You can call them, you can ask their questions as well. Money Matters Made Simple is again a no frills guide. If you've got a question on first time buyer, how a mortgage works, or any other question, it is all on there. I think we could stop sharing the slide. Maybe we can speak to Vinay here. Just wanted to ask Vinay if you had any experience of mortgages which are any further light on any different type of mortgages that you've done, some that have difficult, easy.
Yeah, so I think the point you made earlier about people being aware of what interest rate they're on, you'd be surprised at the amount of people who are on standard variable rate, and a simple conversation with either your lender or a mortgage broker can lead to substantial savings. Also be aware that when you're fixing your mortgage or you take out a mortgage on a particular rate, there's usually an arrangement fee for that. And just be mindful that every time, if you do a 2-year fixed rate, then again, when you come to remortgage in 2 years' time, you'll have to pay another arrangement fee to the lender. So sometimes the longer term rates, if appropriate for your circumstances, can be a better, more economical way to borrow money. Yeah, like Paresh, a lot of people are under this misapprehension, I think, that some of the government schemes means that you can just borrow at 95% with a 5% deposit, for example, but then the income affordability doesn't play. But you have to be able to prove the affordability is still there, and it's not as easy as some people I've had conversations with seem to think it is. So just be aware of that. Yeah, but the biggest thing I would say is that if you're not sure, definitely seek advice from a qualified broker or a financial advisor, and they should be able to help you out in all matters on mortgages.
Yeah, I think one of the other things I wanted to share is that conveyancing, that process can, the buying the house, seeing the property, agreeing the price is great, and people have done it, and then they get the mortgage offer. But the conveyancing is quite key to the whole process, and I have more clients sort of screaming that their solicitor isn't doing what or conveyancing isn't doing what they're supposed to do, and it's causing delays. I don't know. I'm sure by your smile, it looks like you've had the same same sort of issues for your clients. It is important that you choose a conveyancer that has got a good feedback and don't always look at the price. Cheap is always isn't the best. A good conveyancer who deals with all the lenders in the market, and usually lenders that solicitors or conveyancers that deal with all the lenders, that you have a conveyancing standards mark on their website letterhead. So that's always a good sign.
And the other thing also just to bear in mind that is all solicitors and conveyancers are not on the panels of all lenders. So sometimes you can be doing a mortgage with Santander, and if your particular solicitor or conveyancer is not on that panel, they won't be able to represent you for that mortgage. So it's always good to make sure that whoever you're using is also on the panel of the particular mortgage company you're also looking to use.
One of the questions, which I think is an important point, get a mortgage in principle stands you in a better position. I have slight disagreement with that, and you tell me what you think. But I kind of feel that talk to a broker or advisor before you're going to go through the process. They can generally tell you what you can and can't afford. And then once you've got that they can do the affordability calculations for you, and then go and make an offer with the estate agent. And the estate agent, if I know the estate agent now want an agreement in principle first. Getting an agreement in principle from a good broker shouldn't take more than a day, as long as you've supplied them with the information up front. The reason I disagree with getting the agreement in principle before you go and place an offer, because things change. You put in an offer today, you don't get that property, you've got the agreement in principle, and then that falls through. So another broker, another different price, you need a different. It could potentially have an effect on your credit score. So that's why I don't like doing it, but it's something that if the client wants, but I think always be careful that every time there's a hard credit search done on when you've made a mortgage application, it leaves a footprint. The more footprint that's left on your credit file in a short period of time, it could have an effect on your credit score. Because the lender will say, well, you've been to half a dozen lenders. Why? Why have you been there? So it's one of those things. And try and make sure you give consistent information to whoever you are. If you're on £40,000 salary, say 40,000. Don't say it's around 40. I think you have to be accurate, because it could help you make the application a little bit quicker.
Yeah, agree.
Is it possible to remortgage for helping your children buy their first-time buyers?
Yes, so it's a good point, and there are mortgages that are available where parents can help out their children by being part of the mortgage, but then the title being only in the child's name. But again, it's an affordability question, and again, something that you'd have to take advice on to make sure that you have enough income to help your children onto the property lender as well, using your parents' income to substantiate maybe a larger mortgage. And be aware that if you do that, then all parties to that mortgage are responsible for that mortgage. In case one party doesn't make the payment, it could have an impact on everyone else on that mortgage as well.
One of the questions I've had is, whether what's the advantage of a personal or limited company? What's your kind of advice? What are your what things would you find about something like that?
Sorry, Paresh, you're breaking up. I couldn't quite hear you.
Personal name or company name? Go this time.
Personal name or limited name, did you say?
Company, which one, and what are the pros and cons?
Yeah, so they all have both have pros and cons, and probably more to list than I can probably maybe mention on this call, because we've we've got a few minutes left. But both types do have advantage and disadvantage. I would say that's probably a conversation that we can take offline if someone
Yeah.
would want to contact us.
Mm.
But yeah, both have equal disadvantages and advantages based on your personal circumstances.
Yeah. Yeah.
So, Paresh, shall we summarize?
Yeah.
So, summary, I would say the main thing is review your mortgage regularly. I think we've said that before. Make sure that you seek advice from an expert if you're unsure, and keep track of your credit score, which can ultimately be detrimental if you've had any mishaps in the past. And one other thing I would suggest is that if you are using a broker or a financial advisor, be open and be honest. You'll be surprised the amount of people who sometimes think it's not an appropriate thing or a relevant thing to say, oh, tell us the full details of their circumstances. It wastes everyone's time. And again, we're applying for a mortgage for you, which will obviously get rejected on that basis. So just be mindful of that, I would say.
You're spot on there with that. I've just recently buy-to-let mortgage application. The commitment now, the lender.
Sorry, Paresh, I don't think we can hear you. It's breaking up again.
Oh, okay.
I think the gremlins are definitely back.
Yeah.
I think another 50p in the meter is probably needed.
Yeah, what's happened there? So
I'm not sure if we've got any questions.
No, we don't have any more questions. I think, Vinay, if you can just summarize and then just talk about what we're doing next session,
Sure.
and then we can close.
So yeah, just to summarize then, I would say that mortgages is obviously a very complex area, and there's a lot of criteria that keeps changing with lenders. So I would say use a good mortgage broker or a financial advisor, and take advice is, I would say, is the key to all of this. And also be aware that we have not been able to cover everything on this particular call. We tried to keep it as simple as possible, and some of the intricacies of all these things is best discussed based on your personal circumstances, as I've mentioned before. But I hope everyone has learned something from this session, and again, your valued feedback is always welcome. So please do let us know what you think of what we've said today, and any sort of positive or negative feedback that you have, so that we can improve for the next time. Our next session is on the 19th of July, and it's 19th of July?
15th.
Sorry, 15th of July. I need my glasses. Sorry about that. And it's going to be on the need for protection. So we're going to go through all the different types of life insurance, critical illness insurance, all the different types of cover that's available. So join us for that session at 8 o'clock at the usual time on the 15th of July. Anything from you, Paresh, for closing? No, sorry. So,
What's going on here?
we can sort of hear you bits and pieces. So,
Okay, maybe this is going on. This happened last time, unfortunately. Can you hear me now?
and on and off again.
Yeah. Okay.
I think Paresh Bhai is having issues, so we'll just let him be for now.
Yeah.
And thank you everybody for joining. Thank you, Vinay Bhai. Thank you, Paresh Bhai. And we see you on the 15th of July, was it, Vinay Bhai? Yeah, 15th of July. Okay, thank you. Jai Jitendra.
Thank you, everyone. Jai Jitendra. Bye-bye. Hemal, yeah, I think you'll have to still live.